Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Bulls on the front foot for now. European stocks muted as markets look for inflation moderation. Jeffrey Gundlach says look to bonds rather than the Fed for clues on interest rates. Homegrown Apple now. The tech giant plans to start using its own custom displays in mobile devices as early as next year, dealing a blow to Samsung and LG. And slashed by half, Credit Suisse considers a cut to its bonus pool by 2022 by a whopping 50%, and shares are up. Now, first thing is first, we do also have some breaking news on Credit Suisse that we just brought to you, so we'll go straight to Zurich. But the market, let's have a quick roundup of what we're seeing right now. 0.3% for the Stocks Europe 600. Traders, I think, were expecting some kind of carrot from Jay Powell to figure out his thinking on inflation monetary policy yesterday. We did not get that. It was more actually cerebral on how central banks need to look at climate change. S&P futures pretty much unchanged. I have to say all of this will be moved by what we have in terms of that CPI print tomorrow in the U.S. Now, Credit Suisse is considering cutting the bonus pool for 2022 by about half, and that's according to people familiar with the matter. Now, for more on all of this, we're joined by our Bloomberg finance reporter who helped break this story. She is Marion Halftermeyer. Marion, thank you for joining us. So if you look at bonus pools across the world, especially on Wall Street, they're going to be down. Credit Suisse deeper than the others. How big of a surprise is this, given the terrible year they've had?
We're not particularly surprised at all, actually. I mean, as you mentioned, across Wall Street, it's been a rough year. Deal making is down, but Credit Suisse's situation is a little bit more severe than you could say some of its peers are in, because it's had just a difficult year. It's in the middle of restructuring. It had a $4 billion capital raise, and it's trying to sell off its investment bank. And on top of that, we saw ridiculous amounts of outflows in its wealth management division last quarter. So, you know, all of that's playing into just how much they can pay their bankers and the bonuses.
Yeah, and Marion, I guess the question is, can they retain the top talent or the people that they want to keep? Because we've seen also a number of high-profile defections because, I guess, of the toxicity of the brand. So do we think that the people that they want to retain will still be paid a good bonus?
So that's the tricky part here, is that they have been juggling this fine line between paying up and retaining the bankers they want to retain in order to do that turnaround, and particularly for the Credit Suisse First Boston branding. But at the same time, having to negotiate the fact that they just don't have the money to be paying everyone. So it's a bit rough. I think there is a bit of cherry picking as to which top bankers are getting these retention bonuses. So they don't have to worry about this 50% cut in the bonus pool because they've had some off-cycle bonus, and so it's fine for them. For the rest of the people, it's very discouraging. And, you know, we have heard that there are many people who won't get a bonus at all.
Yeah, and this, of course, will be a blow to a lot of people that have or haven't been told, or certainly that are watching this program. Marion, this is a difficult question because I know 2022 really brought up some surprises on Credit Suisse, but what's 2023 going to be like for them?
Hopefully quieter, but the main theme that we're going to be looking at for 2023 will be how exactly they carve out this investment bank. We broke some news earlier this week about how they are buying Michael Klein's investment boutique to be part of the Credit Suisse First Boston branding, and he's a big name, so hopefully that'll attract some talent there. And so hopefully we'll get a bit more clarity on how they're going to structure that partnership, if they're going to be spinning it off, who are the anchor investors, and what that will look like for the employees who are still figuring out what the bank they work for is going to look like in next year.
Marion, as always, thank you so much. Marion Halftermeyer there, our lead reporter on some of the Swiss banks. Now, stocks in Asia climbing and trading today after, amid upbeat sentiment over China's economic reopening. That's as traders are betting that U.S. inflation data due out tomorrow will show further softening. So we're joined now by Andrew Pease, Global Head of Investment Strategy at Russell Investments, and Mary Nicola, Global Multi-Asset Portfolio Manager at PineBridge Investments. So thank you both for coming on today. Andrew, let's kick off with you. When you look at inflation expectations and the risk of a recession, where do markets end up by the end of the year?
Well, I think it's going to be a challenging year for equity markets. It may be we have a soft period during the year, but we get some gains back, and I think that's the theme. A recession still seems likely. I know we've started the year on an optimistic footing, but when I look at things like earnings expectations, they're still not consistent with the fact that the US is going to have a decent slowdown, potentially a mild recession this year. So I think that's going to be the major headwind that equity markets have to contend with as we go through 2023.
Mary, what do you see the biggest pitfall? And good morning to you as well. Where are you seeing the biggest pitfalls for this year?
You know, one of the key things that while everyone's focused on the Fed and where they're going to stop hiking rates, for us, one of the key things to focus on as well is continued quantitative tightening. So even after the Fed is going to stop hiking, you still have a clear headwind coming through from continuous quantitative tightening and the shrinking of the balance sheet. And that we think is going to be a continued headwind for equity markets and broader markets in general.
Mary, what does that mean for opportunities that you see across the board? Again, is there danger? And we had this warning from JP Morgan Chief Executive Jamie Dimon yesterday that he thinks, given all of the pitfalls right now and the poly crises we could see, the Fed could keep on raising rates beyond 5%.
For us, we're pretty cautious on the outlook. So one of the key things that we've been quite underweight equities for some time. But we think there's some opportunities. So we've been quite selective. So within U.S. Equities, one of the things we've been focused on is U.S. quality, so higher quality names, some companies that are going to be able to withstand some of the key challenges that are coming through. Another one that we like is Chinese equities. Chinese equities, especially with the reopening and the rapid changes in the zero COVID policy, we think there's some upside there. And for example, for us, valuations are quite attractive in China equities. Another thing, and Andrew touched upon this, was the fact that because we do see a recession coming through in the U.S., one of the things that we do find attractive is the back end of U.S. Treasuries. So think the 30-year, we find good value there.
Andrew, where do you see the biggest value?
Well, I think the duration call is probably worthwhile. I think the steepener is probably something which is realistic to think about right now. In terms of finding where value is right now, it's been challenging for quite a while. It's hard when you look across equities to find anything that's much better than fair value, but a lot's going to depend on what happens to Treasury yields. And if we do see Treasury yields start to come down as we go through the year, then obviously that brings some value back into equity markets.
Mary, one of the big winners, of course, last year was value investing relative to growth investing. Is that one of the themes that will continue this year?
You know, it hasn't been for us, and obviously there was especially a violent shift that we saw last year from growth into value, especially as rates rose. But we do find a lot of sectors within value equities quite expensive. So from a valuation perspective, it's not that attractive to us. So we continue to try and find pockets. Another one that we're looking at is pockets within new energy. So especially with what's happening in Russia and Ukraine, obviously, some of the key things that is going to be is that governments are moving forward a lot of their objectives in terms of carbon neutrality. So one of the key things that we've had is an allocation into new energy. So think of a lot of the traditional new energy companies like wind and solar, but also utility companies that are actually transitioning to new energy that we see as quite attractive.
So, Andrew, to Mary's good point, and I'll also ask about this, energy, though, last year was really the outstanding sector, outpacing everything else by a pretty wide margin. What happens in 2023 with energy?
Yeah, it's a great question, isn't it? It's going to determine a lot. And I think one of the surprises of early 2023 has been how much energy prices have stayed subdued, particularly with oil prices down under $80 a barrel, and certainly what we've seen with natural gas prices. A big question is going to be around geopolitics, and a big question is also going to be around what happens with the Russia-Ukraine war and how much does the China reopening start to push up commodity demand as well. So I don't think we're likely to see an energy shock. We know that energy markets, particularly oil markets, are pretty tight right now, but I also think that OPEC is going to be managing the supply side quite closely as well. So I wouldn't expect to see a lot of downside from oil prices here, and there may be some upside when the Chinese reopening comes through, but I wouldn't imagine that we're going to have anything like the energy price shock that we saw in 2022.
Mary, if you look at oil and gas prices rolling over in the last couple of months, how do you play that story?
Actually, one of the key things, the key strategies that we've had for quite some time is playing on the backwardation within the commodity curve. And that was across all different commodities. It wasn't specific for any particular one. But as we've seen the backwardation starting to normalize, we've actually taken that off. And we do see spot prices likely to come up as a result of the reopening in China. While we don't think that the China reopening is going to be based on what you see as your traditional reopening, where it's more investment-led growth, we do think that domestic demand is going to play a bigger role. And we saw that with the Economic Working Committee in December, where they were focused more on domestic demand and how to improve domestic demand in China. So yes, spot prices is likely to come up, and we don't see the backwardation as attractive anymore.
Andrew, when you look back to 2022, of course, we saw some pretty, tough valuations or falling valuations in certain sectors, but earnings seem to be holding up. What are you expecting in terms of earnings for the next couple of quarters?
Yeah, earnings are going to be the big story. And I think that's where really if we go, like right now, we're in this phase in markets where softish news is being applauded and markets are going up because they're thinking that makes the Fed less likely to act and people are looking for the soft landing. But when we actually start to see that data start to weaken, particularly the labour market data, and as the earnings numbers, and they're starting to get revised down lower, but as those earnings numbers start to turn negative, which they should if we are heading towards at least a mild recession in the US, I think that's going to be one of the stories. And can we withstand, can multiples withstand the earnings downgrade, I think is going to be the story of 2023. So from where we are, there's not a lot of upside for equity markets in general, particularly the S&P 500. And there certainly could be some downside if we do get that earnings shock heading through, say, the middle of the year.
Yeah, Mary, do you agree with that?
Yeah, actually, we have a very, very similar view in the sense that we think that earnings are going to start disappointing and disappointing even more. We haven't seen that yet come through. And we think the next few quarters are going to start showing that slowdown that we've been expecting, in terms of hinting at a recession in the US and even in broader Western markets. So we're expecting earnings to continue to disappoint even more over the next few quarters. And rather than being better than feared, we're going to just see outright disappointment.
Mary, how do you play the reopening of China?
So we've actually had an allocation in China equities, so both China A and China H. We see value there. We see valuations quite attractive in China. And also, we're going to start seeing that reopening really come through. It's going to be bumpy. There's no question. So the real thing is, being able to withstand that, especially within the first few months. We see it already in terms of just how things are playing out, in terms of seeing a spike in COVID cases within China and some of the data coming through. And it's going to be bumpy, but we do think that things are going to start playing out and that things are going to improve in China, especially over the next few months, and really benefiting from that reopening. So which is why we've had an allocation both in China A and in China H equities.
Andrew, how do you play China?
Yeah, so we run a manager process. So what we're seeing is the alpha opportunity in China looks very strong right now. Our managers are seeing more opportunities they have universally than we can recall them ever seeing before. The challenge with China is the beta. What happened to the Chinese economy? There's a great story building once we get past the COVID spike about the reopening, but the property market is still a problem. The government is already quite stretched fiscally, and it's a matter of they're talking about potentially easing those red lines on property developers, but can they get the type of property market recovery that's required? And the consensus has really pushed up its expectations for Chinese growth this year up to around about 5%. And I think it's going to be a bit of a challenge for them to get there. I think, yes, China's going to have a better 2023 than 2022, but I think that we have to be realistic about just how large a headwind that property sector is.
Thank you both for joining us. Terrific conversation getting us started for 2023. Of course, Andrew Pease, and we'll have plenty more from Mary Nicola as well. Now, coming up, we have plenty more on investment. Court documents and FTX bankruptcy case reveal the celebrity shareholders set for wipeout. We'll have all of the details later, and this is Bloomberg.
next week. Bloomberg is live at the World Economic Forum annual meeting in Davos, Switzerland. As energy crises loom, wealth inequality intensifies, and global power dynamics dominate headlines. Trust Bloomberg for the fastest coverage and exclusive analysis from the world's top leaders and experts. Coverage begins next week, only on Bloomberg Television and Radio.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. The World Bank has slashed its growth forecast for most economies this year, warning that any new shocks could lead to a global recession. The lender estimates world GDP will grow 1.7% in 2023, about half the pace it's projected in June. That would be the third worst performance in the last 30 years after the contractions of 2009 and also 2020. Now, Bloomberg has learned that Apple is planning to start using its own custom displays in mobile devices as early as next year. It's part of a sweeping effort to reduce its reliance on firms including Samsung and LG and bring more components in-house. Sources say it aims to begin by swapping out the display in the highest-end Apple Watches by the end of next year. Jay Powell has set out the limits of the Fed's role in promoting a greener economy, vowing it will not be a climate regulator. Speaking in Stockholm, the Fed chair says the U.S. central bank will stick to its mandate of maintaining price stability. Powell says without explicit legislation, it would be inappropriate for the central bank to be a climate policymaker. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Leanne Gerrans here in London. Coming up, strike season. UK ambulance workers head to the picket line to protest pay. We'll have plenty more on that next, and this is Bloomberg. Let's talk strikes. And UK ambulance workers are holding a second walkout today over real-term pay cuts suffered by NHS staff. Now, that comes as the government plans new laws to limit disruption from future strikes. Now, for more on all of this, we're joined by our UK reporter, Lizzie Burden. Lizzie, good morning. I mean, it is, amazing that this has been lasting for quite some weeks. Today, it's, of course, ambulance workers. Are there any signs of progress in the talks?
Well, actually, the tensions are really high between the government and the unions. I was speaking to the boss of the GMB union, which is involved in the ambulance drivers' strike today, and he compared the anti-strike legislation that the government tabled yesterday to something that a dictator would do. He mentioned Vladimir Putin because, of course, it's going to curb workers' right to strike. But there has been some good news, and it's been reported by our reporters, that the government is considering backdating pay, and that would offer some sort of compromise between the union's demand and the government's refusal to negotiate on pay for this financial year. So the other union that's involved in the ambulance drivers' strike today, Unison, described it as a chink of light, that finally they're talking about pay, even if there isn't a written offer on the table. But what I think is going to be interesting today is at Prime Minister's questions. Yep. Does Keir Starmer, the Labour leader, actually go there on strikes when actually it's a pretty difficult position for Labour as well? So, Lizzie, if you look at the anti-strike law, I mean, would it even work, or is it just a negotiation position? Does it get through? Well, it's going to take ages to get through if it does. It's going to face opposition in the House of Lords, in the courts, and if it passes, Keir Starmer has said that he would repeal it upon entering office, which harks back to the 1970s industrial relations legislation as well. The thing that the government keeps hammering home in the past 24 hours is that you've got similar legislation to this in Europe, in France and Germany, and it's less stringent and it's quite effective in providing a minimum level of service. That's what the government wants. But in terms of where we go from here on the negotiations, it seems to me, if I were going to bet, that no one placed a bet on this.
I was going to say, we'll put a poll on social media. You can bet there.
The nurses are going to be able to hold out the longest because they've got the public with them, and their problems in terms of working conditions are just so tied up in the health services problems more generally. And when we've got an ageing population, they seem to be really intractable.
Yeah, I don't write to my IMP often, but I did write actually on this. Yeah, during the COVID, when we were all clapping at 8 p.m. It feels like a long time ago. Lizzie, thank you so much. Lizzie Burden there with the very latest on these strikes. Now, we'll also be covering all things UK every week, Thursdays, 9:30 a.m. in our half-an-hour special. Coming up, the World Economic Forum Managing Director, Saadia Zahidi, on the WEF's Global Risks Report 2023. That interview is next, and this is Bloomberg. Here, your top story, bulls on the front foot for now. European stocks edge higher as markets look for inflation moderation, while Jeffrey Gundlach says look to bonds rather than the Fed for clues on interest rates. Homegrown Apple, the tech giant, plans to start using its own custom displays in mobile devices as early as next year, dealing a blow to Samsung and LG. And slashed by half, Credit Suisse considers a cut to its bonus pool for 2022 by a whopping 50%. Shares trade higher. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the World Economic Forum has published its 2023 Global Risk Report ahead of Davos next week. The cost of living crisis tops the list for the next 2 years, while environmental risks will dominate over the next decade. Well, I spoke to Saadia Zahidi, Managing Director and Partner for the World Economic Forum, about the risks we're also facing right now.
It is playing out to be one. We have this risk of poly-crises emerging because so many things are happening at once. There's the currently unfolding risks, and that's where we looked at sort of year zero. Where are things today? And it's very clear, energy crisis, food crisis, top of the list. Then we look 2 years out, and the cost of living crisis is still expected to be the #1 risk at that time. And I think it's because people are not really expecting to come out of this current situation very quickly. And then there's the 10-year risks, and 6 out of the top 10 all about climate and the environment.
Is there a danger that we don't fix the climate and the environment because it's going to be so ugly in the next 2 years?
So this is exactly what we're pointing out, that leaders can no longer sort of say, let's address the short term first and then we'll look at the long term, because this is it. The entire time horizon has to shift. And if we're going to look for solutions, there have to be some synergistic solutions that, for example, look at climate and food at the same time, that look at agriculture and energy at the same time. If we don't do that, we don't quite come out of either the societal crisis or the environmental ones.
Saadia, how much have these top 10 risks actually changed in the last 3 to 4 years?
So it's very clear that climate is actually just continuing to grow in severity, and that's really not changing in the 10-year time frame. But in the shorter term, economic risks, societal risks are at the very top. The last time inflation was at the top, or last time inequality was at the top, was more than 10 years ago. We're talking about at the time of the global financial crisis. That's when these concerns were last there. So this is all fully back at the moment, and I think this sort of crunch time that leaders are facing, they're potentially unprepared for. Very few leaders in today's generation have been through these kind of more traditional risks around food and energy, while at the same time battling what's coming up in terms of debt, what's coming up in terms of climate. So we're going to need a sort of new type of leadership that is much more agile and that can have the short and the long-term time frame.
Are chief executives and leaders actually underestimating the new economic era that we'll see in the next couple of decades?
You know, every day there's sort of a new prediction around, are we heading into a recession? Are we not heading into a recession? I think the main point here is we have a few tools that leaders are continuing to use, but those tools then have repercussions. As interest rates get higher, there's also a lot of concern around what's happening in emerging markets. We could be entering a vicious cycle. And so there has to be some medium-term thinking, some thinking about the kinds of investments that are non-inflationary, but will put in place the basic resilience and the shift in our sort of economies and economic structures, especially towards a more green.
Well, that was Saadia Zahidi, World Economic Forum Managing Director about global risks. Of course, they published their global risk report today. Now, billionaire New England Patriots owner Robert Kraft and star NFL quarterback Tom Brady are among those sharing in the pain of FTX's sudden collapse. Bankruptcy court documents reveal Brady alone owns more than 1 million shares, which are now assumed to be practically worthless. Well, joining us now is Ana Herrera, Bloomberg's senior crypto editor. Ana, thank you for joining me. We were all poring over this yesterday because we had been waiting to have some kind of filing on who lost the most money. Do we have any idea of how much these shares were worth when they bought them?
We don't know how much he lost in terms of amount of money. And this is interesting because we found out who some of the equity shareholders were. Obviously, there was such a complex organization with so many investors, but we still don't know who the biggest creditors are, which is a thing that needs to remain. It's interesting. We found out, as you mentioned, sort of Tom Brady's holdings, which were quite big, but we knew he was an investor. He was in their ads. And also goes to show how, mainstream FTX had become and how much it contributed to getting regular investors on board. I was speaking to someone who, said I was a big fan of sports, and, you saw all these big athletes, and it made me think it was a great, safe place, and it was legitimized by these people.
So, Anna, when you look at those, what surprised you the most? Who was invested in, or the amount of people?
The amount of people, so many investors. There were lots of, family offices as well. So it goes to show, regular investors lost money, but also people that were a bit more experienced that has an opportunity to buy equity in the company, as well as the big funds. SoftBank was an investor, Tiger Global. They also kind of lost money.
So the other story, of course, Coinbase cutting jobs.
Yeah.
The winter was rough. What's the rest of the year going to be like?
Yeah, it seems like we're getting into this. We were discussing this yesterday. We're getting into the second year, I think, of the winter. Coinbase, of course, has been through other winters before, so they're not a newbie to challenges. But what they were saying is now you have a crypto winter coupled with a recession broadly, or just tougher macroeconomic times. So they've had to cut again. It's the second time they cut. It's interesting because they're public, so you get to see a bit more behind the scenes of what's happening. With other exchanges, it's a bit harder, and they might not talk about the layoffs, or they might, not talk about their financials as transparently.
So, Anna, overall, what challenges? There are many challenges, but if you look at the exchanges, are there any, specific challenges that we really need to watch out for this year?
Obviously, lower trading volumes are a problem because they make money with fees. So if that keeps going on, then they have lower revenues. We also have discussed the issues around transparency of reserves. Do they have enough money? We've had exchange runs before. Binance had a rush to withdraw. Now things have stabilized, but it's one thing to watch, right? If people lose confidence in an exchange and they suddenly rush to withdraw, will their money be there, or will we have another FTX type scenario?
So is this the year? we talk about, valuation leverage, but this was something different.
Yeah.
What does it mean for crypto this year?
Yeah, we have to see if, the players that came in, the big money stays there and they hold, and maybe Bitcoin keeps it. It's kept a fairly stable price, much lower than a year ago, but it's still fairly stable. If that maintains, if the industry likes to say we're building, but a big question is building what, and what money now, right? Because I guess many of them are in saving mode, as we see with Coinbase, cost saving. So it'll be interesting to see what happens for sure.
Anna, thanks so much, as always. Ana Herrera, there, Bloomberg senior crypto editor. Now, coming up, we get the outlook for M&A with JP Morgan's Dewan. He's optimistic about the next 12 months, so we'll ask him why. And this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. So M&A volumes fell materially in 2022, but we're well ahead of averages for the last 10 years, providing optimism as we start the year. Well, that's the view of our next guest. He's Dewan. He is co-head of EMEA M&A at JP Morgan. Thank you, Dewan, for joining us. I mean, you always make us smart on what you're expecting the year to be, and you're quite optimistic about the next 12 months. Why?
Now, first of all, thank you for having me on. And we are cautiously optimistic, is what I would say. I think when you look at last year, down 36% globally, down 36% in EMEA. But actually, when you look at the long-term trend, 8% ahead globally of the average and 2% in EMEA. So putting the year in context, 2022 that is, it was a kind of an average year, not too hot, not too cold. In terms of this year, I think we see that continuing. I think it's going to be a relatively average year, probably flat overall, and probably a year of two halves. A bit like last year in terms of the next 6 months could be tricky as things settle down, particularly equity valuations, the debt markets coming back, equity markets coming back to support those M&A transactions. And then we're hoping that the latter part of the year, latter 6 months, say, will be kind of stronger in terms of announcements and general momentum. So that's how we see.
But, Dewan, so we're going to, I don't know how long you're expecting interest rates to be higher, but this is a new economic era.
It is.
And we could see this for the next decade. How much does this impact actually just the level of interest rate and leverage, M&A and everything you have in the pipeline?
I think undoubtedly there's a transition period as frankly people get used to the higher rates, the lack of availability maybe of debt, but the debt markets, they'll come back. And when we look back over a 20-year period, when we saw interest rates at these levels, the actual levels and volume put through each year were equivalent to some of the best years we've ever had, 2006, 2007, etc. So we're not overly perturbed. And to put it in context, the likes of a 2006, 2007 type year was well ahead of the strongest year we've had very recently, which, as you know, was 2021. So again, cautiously optimistic, not getting too far ahead of ourselves, but we see things coming back reasonably strongly.
What are the specific sectors that you're most interested in? I know last year, overall, it was tech that really dominated it, and in Europe, it was diversified industries.
Exactly, and I think if we look at EMEA specifically, I think diversified, given rotation of assets, consolidation, general fragmentation, we probably see that as one of the leading sectors. There's a lot going on in terms of energy transition, which I think benefits diversified industries, but obviously the energy sector, as large as it is and wide as it is.
And that's despite the war in Ukraine?
I think so. And I think in some ways, because of it, that actually people are looking at other opportunities and ways to generate that energy and provide to the customers. I think other sectors, your point on tech, I think globally that is certainly going to be one of the leading sectors, same in EMEA. And it is really about the tech evolution that is occurring, the enabling of tech within older economy type of industries, diversified particularly. So we see that theme generally across the market. The other thing I'd add would be that sectors maybe that haven't been as busy in recent years, maybe a healthcare, a FIG, they tend to have a pop-up year every 2, 3, 4 years, and we probably see one or two of those coming back reasonably strongly for all the reasons you know, and that is people seeking opportunities for growth, consolidation, and costs.
In your many years' experience, of course, as a banker in M&A, is there good M&A compared to bad M&A? So the M&A that you either do out of desperation or just because it looks attractive, and how do you not fall in that category when you're trying to make a deal?
Well, I think there is a general caution around at the moment. So I think people are extra sensitive to exactly that point. So we're hoping that it is careful, well thought out, strategically led M&A that occurs. There's always M&A which you, in hindsight, wish you maybe hadn't done, the deal you didn't do. But that is with every cycle. And a lot of it often is not necessarily the deal itself, but the implementation afterwards. And things change, environments change, etc., that make that implementation trickier. But we're hoping for good M&A.
Well, we are. Everyone's hoping for good M&A, especially the people involved. When you look at the different countries, so is the UK, again, are there opportunities in the UK because of cheaper valuations, because of weakness in pound, compared to, say, a France or a Germany?
Well, I think I'd answer that in two ways. I think we expect the likes of the UK to be a leading M&A generator in 2023. The big economies of France and Germany are never going to be far behind. They probably fell further back last year compared to the likes of the UK, despite the economic turmoil that we saw. So UK we expect to be strong, other leading economies as well. And I think the cross-border point, driven in part by currencies, never a reason to do a deal, a strong currency, but it will help people to get the deals done, make the financials work. And that cross-border element we are watching carefully. Last year was a slightly muted cross-border year. This year we expect it to be stronger.
Okay, every year someone comes on and says, this is the year where we're going to see activist shareholders in Europe, much like we do in the US.
Yep.
Is this, I mean, is there attractiveness just because it's a smaller capital pool in Europe? Or, and how does that change? Are we going to see big investors trying to shake things up in Europe?
Well, I think we've seen one or two of them in recent days, as you know. Looking at it, last year, definitely more muted.
Yep.
We had 77 campaigns in EMEA publicly versus 98 in the year before. We think a lot of the activist campaigns were sitting in the background. A lot of work being done,
Yep.
a lot of it in private. We expect more of that to come to the foreground in 2023. So I think the prediction, if you like, would be more public activism occurring for some of the reasons you're mentioning in terms of particularly driving equity valuations, maybe forcing companies to really think about their structure, what should be spun out, maybe sold off, or indeed consolidation opportunities that management need to get on with.
I mean, is this like a chief executive's worst nightmare? Someone, buying shares and thinking they can do a better job. This is like backseat driving.
It is definitely tough for management teams, but often management teams are actually quite well prepared for it, and they recognise that actually activists, they are a form of investor, which you listen to, you engage with. Hopefully there's something to be shared and gained on both sides, but at the end of the day, focusing on the strategy and the performance and the delivery to shareholders.
All right, Dwayne, thank you so much for joining us. Dwayne Lyside, they're co-head of EMEA M&A at JP Morgan. Now let's get straight to the Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Bloomberg has learned Credit Suisse is considering cutting the bonus pool for 2022 by about half, capping a grim year for the bank. We understand the Swiss lender is set to make even more drastic reductions to variable compensation after the 32% cut for the previous year. Now, Bernard Arnault has appointed his daughter Delphine to run LVMH's second biggest brand, Dior. This as a 73-year-old billionaire continues to elevate his children to key posts in his luxury empire, having recently given his eldest son a wider role within the business. Now, French unions have called for a day of strikes next week as an initial response to a government plan to gradually raise the minimum retirement age from 62 to 64 by 2030. President Emmanuel Macron argues a change is needed to boost low employment rates among older people and to keep a cap on rising costs for the government. Bloomberg has learned that Apple is planning to start using its own custom displays in mobile devices as early as next year. It's part of a sweeping effort to reduce its reliance on firms including Samsung and LG and bring more components in-house. Sources say it aims to begin by swapping out the display in the highest-end Apple Watches by the end of next year. A White House official says President Joe Biden has asked Treasury Secretary Janet Yellen to stay in her post. We are told the US president made the request, which he did accept in mid-December. The move ensures stability ahead of another upcoming fight in Congress over raising the debt ceiling. And that's your Bloomberg Business Flash. Francine.
Thank you so much, Leanne. Now, coming up, Elon Musk's plummeting personal fortune. That's today's Bloomberg Big Take, so we'll have that next. And this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Elon Musk might never be able to reclaim his title as the world's richest man. With the ongoing Twitter drama and Tesla stock tanking, his net worth has fallen more than $200 billion from its peak on our billionaires index. Now, today's Bloomberg Big Take examines plummeting personal fortune for him. Now, for more on all of this, we're joined by our Bloomberg wealth reporter, Anders Mellin. Anders, thank you for joining us. So first of all, I mean, it is pretty incredible that he lost more than $200 billion in a year, but we've been following his trials and tribulations very closely. When you look at the trajectory, what's the most surprising?
I mean, the most surprising is the sheer amounts involved. 200 billion is just a staggering amount of money for anybody to lose, and to lose in such a short period of time. It was just, I mean, Tesla shares were at a high just in late 2021 when the equity markets generally were quite buoyant, and then things started going downhill first slowly and then rather quickly once Russia invaded Ukraine and with the larger effects that had on the global economy. And then you put on top of that Musk's acquisition of Twitter, which at first looked like a ploy and then was serious and has ended up having actual consequences for him. It's restrained him financially in a way that he hasn't been in the past. And it's also taking time, many are concerned, away from his duties at Tesla. And I think that is having an effect on the share price, at least in the short term, if you look at what some big investors are saying.
Yeah, so Anders, how did Tesla actually help Musk be the richest person in the world?
I'm sorry, can you repeat the question?
So how did Tesla help Musk become so rich?
So it harks back to a couple of things. First off, he got 3 rather large compensation packages over the last 14 years at Tesla. They've really built his stake in the company. They've also served as a really great marketing vehicle to sort of set the path for the company. These packages have been really audacious, really large, and really just bold in their how they were formed. And that has led people to really adhere to Elon and see that Tesla is a company that's pushing for things that other companies might not do. And that's helped rally a lot of investors around the company, which has driven up the share price. And that's benefited Musk in that since his stake has grown and both in size and in value, he's been able to take out loans backed by that stake and invest in other ventures that he's involved in, like SpaceX, like Neuralink, like the Boring Company.
So, Anders, what's the deal with his Tesla-backed loan now that the share price is down? What happens next?
We don't know the precise details. We do know that he, over the years, has backed quite a significant share of his Tesla stake as security for margin loans. We don't know how much margin loans he's been taking out over the years, but it's fair to assume, I think, that he's been taking out quite substantial amounts to fund his other ventures. And that, of course, has led to questions whenever Tesla share prices dropped. Does he have loans to such an extent that he will get a margin call? And there's been more questions raised about that this year. And what we have seen concurrently with the share price going down is that Musk, who historically has held on very tightly to his Tesla shares, has actually sold off as much as 40 billion now over the last 14, 15 months of Tesla stock. And that leads some to believe that he had to make at least some of those sales in order to cover for the loan that he'd taken out previously.
All right, thank you so much, Anders Mellin there with the very latest on Tesla. And if you want more on the big take, just go on to NI Big Take. The picture is Credit Suisse up 1.5%. It's considering cutting the bonus pool for 2022 by about half. This is a Bloomberg scoop, and it's according to people familiar with the matter. Now, the Swiss lender, we understand, is set to make even more drastic cuts to variable compensation after the decline we saw in 2021. Bloomberg Surveillance early edition continues in the next hour, and this is Bloomberg.
I think that the tools that we have work. I think there's nothing wrong with our mandates.
That's what the Fed, the ECB, and all central banks are facing, which is, should we do more? Should we do less?
What the Fed is trying to say very clearly is, you guys who are expecting a rate cut later this year, forget about it.
This is Bloomberg Surveillance, early edition with Anna Edwards, Matt Miller, and Kayleigh Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. Fixed income mogul Jeffrey Gundlach says if you want to know where interest rates are headed, don't listen to the Fed. Instead, he says, listen to the bond market. Inflation in the Eurozone is still near an all-time high, but consumer expectations about higher prices are fading back to their long-term normal. And Apple wants to bring more components in-house. It will start using its own screens for iPhones and Apple Watches in a big blow to Samsung. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kayleigh Lyons. Kayleigh Lyons, in fact, on assignment today. Matt Miller with me, though, in New York. And Matt, European equity markets getting a bit of a boost early on this morning as the US futures picture starts to look more positive. Really, we're waiting for the inflation print, though, this week.
Yeah, we are, but there is more optimism on inflation, and that's why you see a slight lift to markets. Check out what's going on in Asia. We have the MSCI Asia Pacific Index up about 0.5%, as well as the Hang Seng, the Nikkei in Japan, up more than 1%. So Asian markets are boosted. We do see the yen right now at 132.5 per dollar. And in terms of what we see in U.S. markets, futures here are up as well. Not quite as much as you saw the cash trade in Asia. So the gains on U.S. futures, I think, are slightly less. Let's change the board, and I can be proved right or wrong. Survey says, yes, up 0.2% on the S&P. So not huge gains, but there is that optimism. Again, it's coming out of Europe, not here. And if you listen to, I guess, Jeff Gundlach, that maybe adds to the optimism. Plus, adding to the risk on feel is the fact that yields are coming down right now about 5 basis points to 356, 357 on the 10-year. That offers less competition to dividend yields on the S&P 500, earnings yield on the S&P 500. NYMEX crude right now, a little changed, up 0.4% or 30 cents a barrel to 75.42. And Bitcoin is, well, it's down a little bit, but it's up compared to where we saw it yesterday and compared to where we saw it last month. So it was stuck for so long in that $16,000 range, and right now we're up at $17,500. Anna, what do you see in Europe?
Yeah, well, Europe does look positive, Matt, then. A little more positive than it was an hour ago. We're up by around 0.7% on the CAC 40, the FTSE 100. The DAX up around 0.8%. Pretty broad-based, this rally across European equity markets. There do seem to be a lot of voices pretty optimistic about European assets right now. Is that because of growth out of China and the impulse back into Europe, despite what that could do to higher commodity prices? Or is it about the inflation outlook, the achievements in bringing inflation down, and the lack of persistence in inflation expectations? We'll get more on that in a moment. This is the retail sector today, one of the sectors doing well, up by 1.8%. We've actually had a mixed reports card out from the retailers today here, Matt, but Sainsbury's to the downside, but JD Sports moves higher, and it seems to be that sentiment that's lifting the sector as a whole as we look ahead to a number of corporates in that sector reporting later on this week. Direct Line Insurance, it is, as the name suggests, an insurance business, and the story goes like this. The weather was cold in December. That resulted in more claims for things like burst pipes and other such matters, and that meant the company said this morning they're not going to pay their final dividend. And that didn't go down too well with investors. That stock down by 29% in today's session, just underlining what happens if those expectations are not managed carefully, I suppose. The French 10-year yield, I put this in, but it could have been the German, it could have been Italian or even UK yields, because we're seeing a very similar pattern to what we're seeing in treasuries this morning. So we're seeing buying of fixed income. We heard Jeffrey Gundlach talking about buying fixed income products. We've heard Jupiter in London talking about buying fixed income products, and we see yields coming down. So here's the French expression of that. And I put the copper price in. It is, this is, well, above $9,000 a tonne. That's the important point. For the first time since June, it seems it's the growth story, the reopening story out of China is helping to lift metals, even if it's not helping to lift oil prices, Matt.
All right, well, let's hear more from that West Coast bond guru. Jeffrey Gundlach says, if investors want to know where interest rates are headed, don't pay attention to the Federal Reserve. Instead, he says investors should look at the bond market.
The Fed funds implied rate by the yield curve, the Treasury yield curve, has really become remarkable, where we see that the bond market pricing shows that the Fed is not going to make it to 5%. They're going to make it just under 5% by May or June.
Bloomberg's Danny Berger joins us for more. So, Danny, what is the bond market telling us, and how does this all play out?
Well, it would just so happen, Matt, that I have a chart in front of me that shows what we're pricing in. So you have the Fed, the median projection from their latest dots is 5.1 for a terminal rate, but the market is pricing in 4.9%. The bigger disconnect probably is what happens after that. The Fed has continued to say that they're probably going to hold around that level while the bond market starts to cut. Now, it's not just Jeffrey Gundlach that's saying that, obviously, because people are pricing that in. It really is a lot of bond managers who've come out and said that. Jupiter, for example, they think Treasury yields could go to 2% as the Fed faces a recession and needs to cut. Of course, on the other side of things, people who aren't necessarily dealing directly in the bond market or aren't themselves, like Jamie Dimon, he said yesterday on Fox Business that perhaps they will need to go above 5%. But here's the thing, is because the market has started to price this in for the first time in some time, we have no longer restrictive financial conditions. If you take a look at the Bloomberg FCON index, it's the first time since April that we are now into easy territory. And this is why Powell yesterday raised some eyebrows, not because of what he said, but because of what he didn't say. He didn't push back against the rally in the bond market, in the equity market that's caused easier conditions. So whether he meant to or not, some folks did interpret that as an implicit endorsement of the rally we've seen of someone like Jeffrey Gundlach.
Can I just to clarify something for a stupid stocks guy like me? Right now, we say the Fed is at 4.5%, right? Because we're talking about, when we say that, the upper bound. They want to hold rates between 4.25 and 4.5. They're widely expected to raise 50 basis points to 5% in February, which is why the market is pricing 4.9, because really it's 4.75 to 5%. So when Gundlach says the Fed's not going to get to 5%, I mean, they're going to be there in 3 weeks.
Well, see, this is the thing, Matt, why that the terminal rate conversation, the gap between the market and the Fed isn't the massive thing. It really is that cuts of what happens afterwards. Of course, Matt, though, I could also say that some folks think that some Fed speakers have talked about going further than 5%. So, I mean, the devil is really in the detail, just saying they'll get right up to 5%. To your point, that's not too different than what we're seeing in terms of some of the pricing what the Fed has said.
Okay, Danny, thanks very much. Bloomberg's Danny Berger. Yeah, a lot of market focus on that 5, whether it'll be the conversation that happens after that that will really matter, or later through the year. Right, Eurozone inflation is in focus. It remains near a historic high, of course, but sentiment around the economy does seem to be improving. Bloomberg's Maria Tadeo joins us now from Brussels. Maria, the European economy took a battering last year, of course. Yesterday, we talked about Goldman Sachs' new forecast saying the economy won't go into recession this year. Today, we've got news about inflation expectations looking fairly normal, which is a big deal. Has Europe turned a corner?
Yes, Anna. I mean, it's Happy New Year. I'm Spanish, by the way, so I say Happy New Year until March. For me, it's completely fair game. But if you put all of this together, it does seem that sentiment has changed. Remember, before the Christmas break, this was going to be the winter from hell, this recession that was almost unavoidable, imminent. And then yesterday, we had that change around with the note from Goldman Sachs. They dropped the recession call. You had Deutsche Bank, by the way, also say there is upside for the euro because of the China reopening. And then, of course, we've seen gas prices go down. The next logical step is that consumer bills will go down. And then yesterday, I sat down with the Belgian Prime Minister, Alexander De Croo, and I asked him, is the worst over? This is what he had to say. Let's take a look.
If you look at the economic indicators, indeed, the fear for recession is diminishing. And there are good reasons for that. One of the reasons is indeed on the energy side. A number of things have helped. I think, first of all, the agreement on the gas price cap was a necessary one.
Which you push for a lot.
And which we push for a lot, and is a strong indication that in Europe we will not pay these very high prices anymore.
And that was the Belgian Prime Minister, of course, yesterday. He sat down with us exclusively on Bloomberg TV, and you heard it. The idea of this recession seems to have diminished. For me now, however, the real question is what happens with the European Central Bank story. If you go back to December, Madame Lagarde was very clear that she would continue to hike, that the central bank would not pivot. She talked about restrictive, potentially. She talked about multiple hikes, guided the market very well to 50 basis points. How will this new narrative feed in Frankfurt? That's, to me, the real question now.
All right, Maria, I want to just point out that Larry David, who made a fairly prescient call, it looks like, in his FTX commercials on crypto, says you can't say Happy New Year after January 7th. That's the cutoff, the official cutoff.
And listen, I'm Spanish. For us, Christmas ends on January 10th, and I continue to say it for months. Why not? It's nice. It's a nice thing to do.
Well, I respect the Spanish. Maria Tadeo, thanks very much for joining us out of Brussels. Let's get to Switzerland. Credit Suisse is considering cutting the bonus pool for 2022 by about 50%, according to people familiar with the matter. The news caps a grim year in which the bank was forced to raise $4 billion after a string of losses. For more, we're joined by Marianne Halftermeyer, Bloomberg finance reporter out of Zurich. So what do we know about the payouts this year?
So it's looking a bit grim, but that being said, we have to put this into context of the broader Wall Street. It's not great for many banks right now. I mean, there were some banks looking at 30-40% drops in bonus pool as well. It is a bit more severe in Credit Suisse's case just because of the year that they've had with the restructuring and the capital raise, and they are really trying to set themselves on the right foot and turn around. But this is certainly not encouraging for all those employees who have stuck by them.
And remind us of some of the big name departures and the issues that this bank has faced over years, Marianne.
Yeah, exactly. So they've been seeing a lot of talent bleeding over the last 2 years, and that stems really, we have to go back 2 years to the Archegos scandal and the Greensill scandal, which caused a lot of losses for the bank. And since then, we've seen the bank have a series of management changes, different CEOs and chairmen, and strategy resets. So we finally had the latest strategy reset in November, and that has, been a bit severe. They're doing job cuts, and they're planning to carve out the investment bank. So a lot will be happening this year as they execute on that, but it will be difficult because they do have to walk that fine line of retaining talent as well.
Marianne, thanks very much. Bloomberg's Marianne Halftermeyer with the latest on Credit Suisse, that ongoing story, of course. Turning to tech and another ongoing story, Bloomberg's learned that Apple will start using its own custom displays in mobile devices as early as next year. That's a blow to partners such as Samsung and LG. Bloomberg's Tom McKenzie joins us now with a look at this. And I was looking for a response in the Samsung share price, and we saw it a bit more perhaps in LG earlier on. So what do we know about the time frame for this change? Today it screens. Yesterday they were talking about chips.
Yeah, and to your point, this is part of a sweeping shift by Apple to bring more of these components in-house, but it's going to be implemented in an incremental way. And on the time frame in question, they're going to start with the high-end, the high-value iWatch, essentially, the smartwatch, by the end of 2024. It's a smaller screen, so it makes it a slightly easier prospect. And the difference is the screen is going to be shifting in terms of the type of screen from OLED to micro LED. But importantly, of course, they're going to be building it, or at least designing it, in-house. I'll have to get an external manufacturer to produce it en masse. But it is that shift. The time frame then, end of 2024 for the watch. Then at some point, they'll change these screens as well and build them in-house for the iPhone. They don't have a time frame around that. But again, to the broader point around this sweeping change from Apple, we have seen, yes, earlier this week reporting that they're going to switch up the Broadcom chips for their own in-house chips, and they've already dropped Intel chips within the Mac. So it's part of that sweeping shift. It's going to be done incrementally. They had some technical difficulties in getting to this screen shift that's held them back. They started this whole process back in 2018, but now they're determined to get to that point by the end of 2024 with at least the smartwatch.
I mean, I wonder when I read these stories, and for years we know that Apple's wanted to bring its entire supply chain in-house. When are they going to be done? When is Apple going to make everything, Tom?
Well, it's still a number of years away. You look at that time frame, they're just starting again with the watch by the end of 2024, if they get to that point, and then years away in terms of the iPhone. So it is going to take time. It's highly complicated engineering, of course. What it enables, or what they hope it'll enable it to do, is to be able to better customize those devices and, to your point, have better control over supply chains. We don't need reminding of how important it is to have control of your supply chain. So that's the rationale. And in terms of the impact, of course, and Anna, of course, mentioned this in the lead up to some of those suppliers, the likes of LG, they get 36%, LG Display, 36% of their revenue from Apple. Samsung, a little less, 6.6%. But nonetheless, you saw those stocks under a bit of pressure on the back of this news. It will take time. It is consequential for Apple. And of course, it's consequential for its suppliers as well.
All right, Tom, thanks very much. Tom McKenzie reporting on the Apple supply chain changes today. We've seen them, of course, over the last couple of days, as Anna mentioned. Let's take a look at some of the stocks we're watching in the pre-market this morning. Bed Bath & Beyond, again. It is a penny stock now, so any little move is huge in percentage terms right now, up 24%, even after reporting a wider net loss than had been expected yesterday. That underscores the likelihood of a bankruptcy filing in the next couple of months. Also, CarMax. JP Morgan cutting CarMax to underweight from neutral. The new price target at JPM is $60 a share. That implies an 11% drop from the closing price yesterday, but in the pre-market, it's down almost 5% already. And World Wrestling Entertainment, WWE, is up more than 6%, almost 7%. It said yesterday its board unanimously elected Vince McMahon as executive chairman. His daughter, meanwhile, Stephanie McMahon, has resigned from her roles as chairwoman and co-CEO. So a lot of drama in a stock that really thrives on drama, Anna.
Yes.
That's the whole point.
Yeah. Drama in the wrestling world and spilling into the markets. Right, coming up on this program, we'll talk markets with Yogi Dewan, CEO at Hassium Asset Management. Is there still hope of a soft landing for the US economy? Yogi can explain why he thinks so and why Elon Musk may never again be the world's richest person. Read today's big take story on Bloomberg.com or on the Bloomberg terminal. We'll get details later. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. Kaylee Lyons is on assignment today. Joining us now to look at the markets, Priscilla Azevedo-Rocha, Bloomberg credit reporter. So let's delve, Priscilla, good morning to you, into the world of credit. And I read from you and colleagues that we've seen a deluge of debt sales in Europe that's pushed issuance for the year beyond $150 billion in the quickest time ever. Why so much excitement in a rising rates environment from corporates to raise money now? I suppose it's because of the rising rates environment.
Yes, that's right. Thank you for having me, Anna. So the market at the moment is very benign. So companies and banks in particular, in Europe is mostly financials focused, but the corporate world is taking opportunity of this moment where investors are coming back to the market. They have money, they're cash rich, and they're looking ahead. Okay, the broader concerns in the market remain. So inflation is still out there. There's a rising rates trajectory. So January is usually a good month for bond sales, right? So why not go now?
Yeah, well, and also it's very popular, right? Over here, yield to worst on IG is like more than 5%, and for junk bonds, it's more than 8%. So investors are loving this landscape. Is that the same in Europe?
That's right, Matt. That's absolutely the same in Europe. So basically, a corporate bond in Europe at the moment is paying about 4%, right? If you look back, only 2 years ago, they were paying about 0%. So at that time, investors were fighting over 1 basis point. Now the market has fallen so much last year, so for investors it's a great entry point because it is coming from such a low point that is a great entry point and is having higher returns. But it's not the same picture for everyone. The junk market remains pretty much closed here because the companies that were paying like 8% last year, now they risk falling into defaults or into administration and things like that. So the market is open, but it's not open for everyone.
Yeah, Euro high-grade bond spreads I see near the lowest since the summer. To your point, Priscilla, thank you very much for joining us. Bloomberg's Priscilla Azevedo-Rocha with the latest on credit markets. And for credit markets and much beyond, check out the Markets Live blog. You'll find market analysis there across asset classes. MLIV Go is the function to use on your Bloomberg terminal. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. President Biden says he was surprised that classified documents were discovered in an office he used before he was elected. He says his lawyers did the right thing by calling the National Archives, which took possession of the papers the next day. Congressional Republicans are promising to investigate. In the UK, ambulance workers are on strike again today. Members of 2 unions are walking out as part of a dispute in pay in the National Health Service. The public's been warned they may have to wait longer, even longer, for emergency services. And Tesla plans to spend more than $700 million in investments on the Austin, Texas campus of its new factory. According to filings, the money is earmarked for a ground-up and complete interior finish of the electric vehicle plant. Construction starts later this month. At the Golden Globes Awards, Steven Spielberg was a big winner. The veteran Hollywood filmmaker won Best Director for The Fabelmans, which is based on his life, and the film won the Golden Globe for Best Drama. I have not seen it. I don't think I've seen any of the movies, but I don't even really know much about the Golden Globes. Isn't it kind of like an also ran after the Academy Awards?
I don't know, but now I've got an even longer, it's annoying, I have an even longer list of things I've got to watch and will fail to find time to watch because that's just what happens when you get older, isn't it, Matt? The Banshees of Inisherin also did well in the awards, but that'll be on my list. Whether I'll get to it will be a different matter.
It's not about the age, it's the offspring, right? If we didn't have kids, we would watch every movie.
There we go. Found someone to blame, and they're definitely not listening, so that's safe. Right, when we come back, we will talk about markets, though. Yogi Dewan will join us, CEO of Hassium Asset Management. Now, that conversation you don't want to miss. He still finds room for a soft landing for the US economy. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. Fixed income mogul Jeffrey Gundlach says if you want to know where interest rates are headed, don't listen to the Fed. Instead, he says, listen to the bond market. Inflation in the Eurozone is still near an all-time high, but consumer expectations about higher prices are fading back to more normal levels. And Apple wants to bring more components in-house. It will start using its own screens for iPhones and Apple Watches in a big blow to Samsung. I'm Anna Edwards in London with Matt Miller in New York. Kaylee Lyons is on assignment. And European markets, US futures to some extent getting a bit of a boost from what seem to be high expectations that we get a moderating in some of the important parts of the US inflation story when we get that CPI data tomorrow. We'll see whether that is well-founded high expectation.
It's a good point. I mean, the really important day for equity markets is tomorrow when CPI comes out. But maybe markets are, listening to Jeff Gundlach today. Maybe markets are optimistic about inflation expectations, as it seems Europeans are. In any case, we do have futures up again here, about 0.25% on the S&P. Not huge, but you have less competition from yields. And this is true, I know in Europe and around the world as well. U.S. 10-year yield coming down about 5 basis points right now, 357. Maybe that makes stocks a little bit more attractive as bonds are offering less. NYMEX crude, a little changed right now at $75.24 a barrel for West Texas Intermediate. So maybe it's not growth expectations that are moving stocks, but really a lack of inflation concern. And then Bitcoin, also little change, but at $17,449, it looks like it's finally broken out of that $16,000 range, at least for the last 3 sessions. In terms of the pre-market movers this morning, we're definitely keeping our eye on Apple. Not a huge movement, but a huge stock, obviously. More news that it's planning to use its own stuff rather than outsource. Today, it's custom displays in iPhones and Apple Watches, replacing stuff made by Samsung as early as next year. Meanwhile, Bed Bath & Beyond reported a wider than expected loss yesterday. That underscores the likelihood of a bankruptcy filing within the next couple of months, but I don't think that's any news to shareholders. So the stock is in the pre-market rallying 30%. Of course, it's only a $2 stock right now. CarMax is down another 5%. JP Morgan cut its rating on CarMax to underweight from neutral. So now it says sell, and they have a price target at 60. That's 11% lower than the closing price yesterday, but we're getting obviously ever closer to that as we drop today. And World Wrestling Entertainment, WWE, is up after the company said it unanimously elected Vince McMahon as executive chairman. His comeback forces his daughter out. Stephanie McMahon has resigned from her roles as chairwoman and CEO. Anna, what do you see in Europe?
Yeah, interesting to see that family keeping the wrestling to the boardroom and out of the ring, which sounds safer. Let's have a look at where we are on Europe then. European stocks making gains today, Matt, up by 0.6%. Broad-based gains across European stocks and keeping up with this positive about Europe theme, which seems to be something that a number of investors talk to us about of late. Is it the benefits of the reopening in China, but certainly or the mild winter? Certainly a lot of optimism around Europe. The retail sector is one sector that's doing well today, up by 1.7%. We've actually had a mixed set of reports today, and this comes course, ahead of a number of other companies that will be reporting tomorrow. Certainly in the UK space, pretty mixed today. Sainsbury's down, JD Sports on the rise, and it seems the market going with the JD Sports line, and so the sector up by 1.7%. Direct Line Insurance, it sells insurance to retail consumers, and they had a tough December. The bad weather in the UK, the cold weather in the UK led to more claims, and that means they're not going to be able to pay their final dividend. They declared that this morning, and the stock has been punished as a result. A big move on that one. Copper is up by 1.3%, but the story really, and the red headline across the Bloomberg earlier on, is that the copper price has gone above $9,000 a tonne for the first time since June. Another case of the Chinese reopening story lifting some assets, not all, of course, because it hasn't done the same things for the oil price, as we know.
All right, we're going to keep our eye on those commodities. Right now, I want to go right now, though, to Yogi Dewan, CEO of Hassium Asset Management. And Yogi, I want to get your take on rates, because that seems to be, at least to some extent, what's moving markets today after Jeff Gundlach said, don't listen to the Fed, instead listen to the bond market. Do you agree?
No, you've got to listen to the Fed. The Fed drives the bond market. It's pretty clear markets are pricing in rates going from 4.5% up towards 5%. Our view here is that we're unlikely to see the 2 rate hikes that the market is pricing in. Maybe we will see one and then a pause. And a lot really depends on 2 things,
Hang on, you don't think the
Matt.
Fed's going to raise 50 basis points on February, February 1st?
I think there's a significant risk that they'll only rise 25 basis points and then another 25 basis points is priced in for later. But at the moment, it really depends on each and every print that we get in terms of economic data. We've got the CPI number out tomorrow, as you've already said. Market is expecting 6.5 to 6.7%. That's a significant decline from an inflation perspective. And of course, the thing that drives share price appreciation is earnings. An earnings kickoff on Friday. We've got Bank of America, JP Morgan, Wells Fargo. And obviously Q4 is not going to be a great season for earnings. We've got earnings growth of -4%, but revenue growth of 4%. And we know that the banks are all going to cost cut. We've seen what Goldman have just announced as well. So our view here is that stay focused on earnings, look at guidance, see what the CPI print is, listen to the Fed. Also, you've got to look at what's going on in Europe as well, which is quite meaningful from a rate perspective too.
Yeah, absolutely. Good morning to you, Yogi. More on Europe in a moment, but just to linger on what your view is on the Fed and where we head on US equity markets. You're expecting, or global ones actually, you're expecting global equity markets to be higher by the end of the year. Is that because you expect a very bad or a very good outcome for the US economy? Because it seems with either conclusion, you can come to a place where you see stocks as higher. So is it driven by the fact that you think that the US economy won't worsen that much? Or is it because you think it'll worsen so much that the Fed will cut?
Yeah, we're long-term investors, so we're not short-term focused in the way we are looking at things. At the moment, we're looking at economic data, which is very mixed. We're looking at earnings data. We know that Q1 and Q4 this year are not going to be good. Our view is that things will pick up in quite a meaningful way towards Q3 and Q4. We're expecting the S&P 500 to be significantly higher by year end. What happens on a day-to-day basis around each and every print is quite hard to work through from an investment perspective.
Yeah, but what drives that second half optimism, I suppose, then?
I guess there's a number of things that are actually going on. I think inflation will moderate. I don't think we'll see as many rate hikes as expected, so you'll start to see bond rotation out of fixed income into equities again. We're also quite pleased to see China reopen, not with all of the COVID deaths, but remember China with zero COVID still had GDP growth of 3.9%. As it reopens, we expect to see things improve. That will benefit Asia, which in turn will benefit Europe, which in turn will benefit the US. So we think the longer-term prognosis, particularly in the second half of the year, is a positive one.
So you're optimistic on the economy and not as fearful as the Fed. This isn't an expectation for a Fed pivot on a recession.
Yeah, we're not expecting a Fed pivot. We're not expecting rates in the way that they're priced to actually start to decline around June, July, which is what's happening in the US. And in fact, even in Europe, they're talking about rate cuts later on in the year. Let's not talk about the UK in this regard because that's a separate point altogether. But from our perspective, we expect to see some rate hikes, not as much as priced in. Sentiment is quite negative. All investors are positioned in a very defensive way. And our sense here is that a lot will happen around COVID, a lot will happen around China, a lot will happen around the war. And earnings, it's earnings that drive share price appreciation, and that's what we're actually going to focus on.
Yeah, and I don't think everyone, on this side of the pond quite appreciates the European-Chinese connection, the bridge there that's so beneficial to the European economy when China reopens. We've seen outperformance already of European stocks. I know we're just on January 11th today. Do you expect that to continue, European outperformance over U.S. equities?
At the moment, Europe's up, some 7% year to date, whereas the US is only up some 2% year to date, depending on which index you look at. The thing to remember about Europe is forward PEs are only 12. In the US, they're 17, and in the UK, they're 10, and likewise in China. So you've got a very strong narrative around valuation in Europe. You've got an improving sentiment around China. You've also got a lot of stimulus that will likely be pumped into the economy, and you've got higher rates, according to Lagarde, 2.5% going up to 4% by year end. Higher rates means banks can lend. That helps stimulate growth. Fiscal spending will help stimulate growth. So we're really now focused on what goes on in Russia and Ukraine. We've had a milder winter. We've seen natural gas prices moderate. We've seen oil prices moderate. It's hard to see the inflation narrative continuing. It's hard to see as many rate hikes being priced in actually taking place. So our sense here is that investors are just positioned really defensively. They will focus on value, and this will help European equity markets outperform going forward. It's a value play.
Yes, and I know that that's something that takes you to Europe, doesn't it? What about the UK? You mentioned it in passing, but it is a different story. I mean, some of the moves, if you see China reopening benefiting commodities, then that can be positive. But is it more a case that that dynamic will benefit Latin American commodity producers and the like, rather than the UK markets?
Yeah, the UK seems to have a lot of domestic issues in terms of what's just been happening with the new government, all the striking that you've made reference to, and that will eventually impact on earnings. It's definitely impacting on consumer spending. So the recovery in the UK is likely to be a slower one. Now, that said, forward PEs are at 10. Sterling is relatively weak on a PPP basis versus the US. And of course, the FTSE 100 revenue stream is predominantly US dominated. So you'll start to see some areas of support, but we think the recovery will take a lot longer.
OK, thanks so much, Yogi. Good to speak to you. Thanks to Yogi Dewan of Hassium Asset Management joining us this morning to talk about his market views. And coming up, we'll have a conversation about what CEOs expect for the year ahead. Most CEOs are fearing recession worse than the financial crisis. That is the view coming out of a survey conducted by EY Global. We'll talk to their Vice Chair, Andrea Grazzoni. He'll be with us to talk through the latest report. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. Kaylee Lyons is on assignment today. Now, a new report from Ernst & Young found a majority of CEOs fear a recession will be worse than the financial crisis. Joining us now with his report is Andrea Grazzoni, EY Global's Vice Chair for Strategy and Transactions. Andrea, very nice to have you with us. So this research by you at your team at EY, tell us what it is that is driving such a sort of pessimistic conclusion from global CEOs.
Thank you very much for having me. I think the situation is really mixed, and you can clearly see from the answers in this survey that involved more than 1,200 CEOs that there is really a combination of negatives that is impacting on their view regarding next year. So basically, 98% of the CEOs interviewed believe that this is going to be a downturn. And I think their view regarding the severity of this downturn is very split. I mean, a significant number of those CEOs believe that it's going to be mild and to a certain extent quite extended in terms of timing. Others believe that actually it's going to be deep. And there is a significant number of those, a majority actually of those responded, who actually believes that to a certain extent it will be even tougher than the financial crisis.
Andrea, can I jump in here? I got to jump in here. If a majority of the respondents think that this recession is going to be worse than the great financial crisis, that doesn't sound mixed at all. That sounds horribly pessimistic, dramatically so.
It is to a certain extent, but I think that probably, I mean, it's difficult for the respondents really to reconnect what happened during the financial crisis with the last 2 years. So I do believe that there are a lot of items in the survey that actually points to the preparation for something that could be very severe. You see their attitude towards restructuring, cost-cutting, outsourcing, and all the CEOs interviewed really pointed out that these are going to be very important measures to control the situation in the next couple of months.
So I think what most of our viewers right now are wondering is, what kind of bonus am I going to get? What kind of raise am I going to be able to negotiate? It's that time of year. What are the CEOs telling you?
I think that they are preparing really for this environment where the level of uncertainty, mainly caused by the geopolitical situation and uncertainty regarding rates and inflation trends, would require very, very severe measures in terms of managing internal costs and managing their P&L. So overall, I think that's positive. I mean, it's a positive way of looking at the future scenario in a way that is proactive. And if you look at the other side of the coin, I mean, you see that a predominant majority of those CEOs are actually planning to do more M&A to stimulate growth and to invest in areas where they think that they can have a better return in terms of capital deployed. So it's a quite balanced view, actually. It's prepared for the uncertainty we all see coming up, and at the same time trying to make the organizations more efficient, more effective.
Okay, yes, I wanted to turn to M&A, Andrea, because you, in your role, Global Vice Chair for Strategy and Transactions, clearly have some visibility around transactions and the type of things that CEOs are talking about. So if 89% want to leverage deals over the next 12 months, what kind of deals are they going to be? One of our colleagues was recently writing about expecting deals in 2023 that secure up supply chains. Is that the kind of activity that you'd expect?
Yes, I think we can see really a continuation of the trend we observed over the last 6 months. There's an obvious appetite for investing in certain sectors, in particular in the technology sectors. I mean, there's an element of technology in every deal now, but I think there are other sectors like consumer products, oil and gas, energy, renewable, are going to become very interesting for obvious reasons. And I think that the kind of deals will continue to remain small, medium-sized, which was the trend really over the second half of 22. And I think we'll be more focused on, let's say, the so-called friend countries. So we can clearly see the cross-border activity declining, especially with regard to certain areas. But I think this will be compensated for more activity domestically and focused and between the countries where there are already friendly relationships. So that's the kind of trend we can see. Obviously, the volatility and the stock market and the higher interest rate, but above all, I think really the uncertainty regarding the interest rate trends are going to represent significant headwinds in the coming 6 months.
Yes, indeed. Okay, Andrea, thank you very much for giving us your time. Andrea Guazzoni of EY with the latest on their research. So a majority of CEOs fearing a recession that will be worse than the financial crisis, but still committing or expressing an interest in some M&A. Coming up on the programme, Elon Musk may have forever lost the title of the world's richest person. We will see. Up next, we'll discuss why that might be the case and what is happening to his wealth. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Anna Edwards in London. Kaylee Lyons is on assignment in San Francisco at a very important healthcare conference. We hope she comes back soon. Elon Musk might never be able to reclaim his title as the world's richest man. With the ongoing Twitter drama and Tesla's stock tanking, his net worth has fallen more than $200 billion. Not $2 $200 billion, but buy more than $200 billion from its peak on the Bloomberg Billionaires Index. Today's Big Take stock examines plummeting personal fortune, and Ben Stupples, our ultra wealth reporter, joins us now to talk about this. So just a massive collapse in Elon Musk's wealth. The first thing I wonder is, Ben, do you think he cares? Because he still has tons of money.
You're right, Matt. He does still have tons of money. He still has a net worth of about 130 billion. Now, let's just think about that number for a second. It's almost enough to buy every team on the NFL. Having said that, losing 200 billion, that is significant. That is significant. And it's worth thinking how that was fueled to start off with. It was Tesla's rise in 2020 of more than 700%. 700%. And the collapse that we've seen since then is pretty incredible.
Pretty incredible. And of course, he enjoyed all of that on the way up because he he had a number of stock options that he was able to benefit from. You talked about sports teams and how many he could buy with his wealth. He doesn't like to play with sports teams, though. He likes to play with social media, and to some extent was distracted from Tesla, so the argument goes, by what he's doing at Twitter. How much is that? How much is that responsible?
I think it's hugely responsible, Anna. I think obviously the macro picture's changed massively for Tesla since 2020. The macro picture's changed. Investors are now concerned about rising inflation, interest rates, making people less, wanting an EV vehicle potentially less. But Tesla's Elon Musk's sideshow with Twitter has made investors really question his leadership of his biggest asset, which of course is Tesla. He needs, some investors would argue, to focus back on his baby, which is Tesla, of course.
We talk about, Ben, all the time, paper wealth, what these ultra-rich people are worth if you look at the value in the stocks they own, the value in the companies that, for example, SpaceX, represents a big part of his wealth. What about real lasting wealth? How much do you think he has in terms of, actual cash in the bank that he can pass on to his, 12 or 13 kids?
I would say, Matt, right now, that's, for Elon Musk, a $130 billion question, his current net worth on the Bloomberg Billionaires Index. To be honest, we may never know the true answer of that, but what we can say is that, Elon Musk has sold a lot of Tesla stock over the past year. At the same time, though, along with that paper wealth, he was borrowing against that Tesla stock. So in addition to cutting his stake, he was turning the paper wealth into actual cash on the side, which he used to partly fund the Twitter takeover. He's also used margin loans in the past from Morgan Stanley to buy homes. He's now sold them. But that paper wealth, he has actually turned at the same time into cash on the side. We will never know the full answer. It's the great mystery of working on the ultra wealth side for Bloomberg News.
Okay. But he is certainly a big fan of the margin loans. Thank you very much, Ben, for bringing us the story. Ben Stupples. And you can go to NI Big Take on the Bloomberg terminal or find that story on our website, all about Elon Musk and whether he will ever be, again, the world's richest person. Now, that is it for Early Edition. Surveillance is up next. This is Bloomberg.